Okay, so people often ask me, how do I avoid drawdown? Okay, so in this video, I'm gonna be showing you guys some of the best practices that I use to avoid it. Now, listen, as a trader, you will have a little drawdown sometimes. You know, we all enter the market in the negative, but these are some of the practices that I actually employ to help me avoid it. All right, check this out. The first thing you have to remember is if and when the market ever goes against you, it's either a fake out or it's going to the next support and resistance level, okay? Now, if you don't already know, I teach my students that when the market is at resistance, you should be trading the market down only. Just like when the market is at support, you should be looking to trade the market up. Meaning if the market is going up to a level, that's resistance, so you should be looking for it to turn around and go back down. Conversely, if the market is going down to a level, you should be looking to trade the market when it gets to that level and set up based on whatever entry strategy you have to go back up to resistance, okay? Therefore, let's look at this setup here. The market was going up, and let's just say it came to resistance and this is the expected level that you were expecting the market to bounce to go down from. So let's say you got in on this candle. Let's say your entry strategy gets you in on this candle and you got in. The market closed here, you in profit. The next candle opened, it gapped down and went down some. You were in some decent profit, but then all of a sudden volatility happened and it went up, took you out of the money. Now let me stop right there. Whenever you're looking to get in the market, this is before you get into the market. Whenever you're looking to get into the market, always measure back to resistance. In this case, since you were looking to trade the market down, measure back to resistance to see if you can afford to allow the market to go back to resistance. Because what happens, the market can, let's just say another setup, you're getting in from resistance, but your entry is down here. The market will tend to pull back to resistance to retest that level, and it could do that a couple times. So always measure back to resistance or measure back to support to see if you can afford to allow the market to pull back. Now, that leads to my next point. If you can afford to allow the market to pull back, then you're good, okay? Now, that's for starters. That's just whenever you're entering the trade, make sure you're basing your entry, or just make sure you can afford to allow the market to pull back, because just because the market pulls back to resistance or back to support, it doesn't mean it's a bad trade. It could just retest that level. Now, let's move forward. So you got in on this candle closed, you're in profit. Next candle got down, went down, you're in deeper profit. All of a sudden, the volatility hit, it went up. The market is now above your level, and the market starts to go up. Now, what you need to do when the market gets away from you, you need to, at first glance, you need to measure to the next resistance level in this case, okay? Because if you measure to this resistance level and this is the next level you feel the market may run to, if you cannot afford to allow the market to run up to there, you need to close that trade out or have a plan B, some other plan. Because if the market is here and you're already at $500 in a negative and you only have a $800 account, that's a lot of money. That's a lot of money you're in a negative. So you should have measured back to see, how far can you afford to allow the market to move back? How much can you afford to be in the negative? That's going to be the amount you cut the trade off regardless. For me, I always measure back to resistance, but as a trader who's trading with a small account or just any account size, you need to know how much are you willing, what's the most that you're willing to allow the market to have you in the negative, or what's the most you're willing to lose if the market gets away from you. That could be $50. So you need to measure back, okay, if the market comes up to this level, or let's say the market comes up to here, I'm gonna be $50 in a negative, I'm cutting the trade right there. Let that be your amount, all right? Do not allow it to go over your amount. So if you're able to do this, if you know the level that you, like for instance, usually I would measure back to the level. If I'm trading on a smaller account, I'm using a dollar amount. Okay? I would say it will behoove you, if you're trading on a small account, to have a dollar amount in mind. In a case like this, measuring back to resistance or measuring back to support, there's nothing wrong with that. You should do that before you get into a trade, to know how far you are from base. So just in case it pulls back, you want to let it pull back so you can let it pull away, and that way you can at least you're not jumping in and out of trades. Okay, but if the market goes beyond your level and it's like pulling away, where it's like, oh man, it comes up to here, that's a lot of money, you need to have a dollar amount in mind, how much you're willing to lose, and stick with that. Do not deviate from that. Stick with that dollar amount. If it's $50, cut it off. If it's 100, cut it off at 100. Whatever that amount is, cut it off. Okay? So, like I said, you can use a dollar amount, or you always measure back to your nearest resistance level or nearest support level to see if you can afford it. How far, or just see how far are you willing to allow the market, what level are you willing to allow the market to pull back to before you say enough's enough. Okay? So that's very critical, very crucial. And I believe if you can employ this type of strategy when you're trading, it will definitely help you. Now, another option would be for you to lock up your trades. All right, just lock up your trades, meaning if you're running a trade going down at $1 and the market pulls back, it goes up too high, and you're like, you know what, I'm not gonna let the market go beyond 50 bucks. And if you don't want to shut down a bad trade, you could, if your broker would allow, you can pop open a trade in the opposite direction at the same volume amount. That's if your broker would allow that, and that's called hedging. Because once you lock up that trade, whatever dollar amount you have between your two trades, it can be $50, $75, whatever it is, those two trades are now locked in together. The remaining money on your account is what you have to trade with. So your goal after you lock up your trades is to get back that value from your negative, that amount is in a negative. So any subsequent trades that you open up in the money, it's going to shrink that amount. If you're at negative $50, you open up a couple trades and they're valued at $15. Once you close at $15, now you have a negative $35. Open up a couple more trades. You're in the money $50. Now you're up $15 when you close them out at 50. All right, so you need to keep that in mind. And I can make some more videos on that, but I think this right here would really help you all realize, it'll give you another way to protect your money on your account, especially if you're trading with a small account. All right, so just keep this in mind. So listen, just I tell you guys all the time, have nothing short of a fantastic day. Remember, stay healthy, stay safe. Let's always remember to remain and stay prayed in the times we live in. I'll see you guys in the next video. All right, peace and blessings, everyone.